All right, settle in. It is Wednesday, January 21st, 2026. This is Talk Tickers, and if you're listening to this, you want the signal inside the noise of earnings season.
Yeah.
Today, we are getting our hands dirty, literally. We're talking land, specifically Forestar Group, ticker FOR. They just dropped their Q1 2026 numbers, and frankly, the market hated it.
Hated it is definitely the right phrase. The stock gapped down almost 7% at the open.
Yeah.
It was a pretty brutal rejection of what was, on the surface, a revenue beat.
And that's the part I want to unpack first. Usually a company tells Wall Street, hey, we made more money than you thought. The stock goes up.
Right.
Forestar reported revenue of $273 million, beating consensus by a decent margin. And yet the stock trades like they announced a sinkhole opened up under their headquarters. What did the market see that the headline algorithm missed?
Well, the algorithm saw dollar signs, but the human traders, they saw volume. Or I should say the lack of it.
Oh.
You have to look at the units column. Forestar is in the business of selling residential lots. In this quarter, they sold 1,944 lots.
And that's down from last year?
It's down 17% from the same time last year.
17%. That's a massive drop.
It's a cliff. I mean, when you're a growth company, or at least when you're priced like one, you can't shrink your volume by double digits and expect a round of applause just because you charge more per unit.
Yeah, okay, so let's talk about that pricing dynamic because the math here is a little weird. How do you sell 17% fewer widgets, or in this case, plots of dirt, but still increase your total revenue by 9%?
It all comes down to mix. Not all dirt is created equal.
Right.
Management made a big point of explaining that this quarter was heavy on deliveries from the West region.
And the West meaning what? California, Arizona?
California, the mountain states, places where land is scarce and regulation is high. A single lot there might sell for 3 or 4 times what a lot in Texas sells for.
So they sold fewer lots, but they sold the champagne inventory.
That's the story. The average sales price, or ASP, skyrocketed to about $121,000 per lot. For context, analysts were expecting something closer to $116,000.
So they sold the expensive stuff. But if they're selling premium inventory, shouldn't that be good for margins?
You'd think so.
Usually the luxury product has the fat profit margin. But I'm looking at the gross profit margin line here, and it dropped. It fell to 20.1% from 22% a year ago. That seems contradictory.
It is, and it spooked people. Management's explanation was a bit technical. They blamed a specific tract sale.
Wait, pause there. We need to distinguish this for everyone. What's the difference between a lot sale and a tract sale?
So a lot sale is when Forestar takes a piece of land, puts in the sewers, the roads, the electric lines, grades it, and sells a finished pad ready for a house.
Yeah.
That's their bread and butter. A tract sale is usually just selling a chunk of raw or partially improved land, essentially wholesale. It's less value add, so it's typically a lower margin.
And they had one of these low margin deals that dragged the average down.
That's the claim. They even gave a number. They said margins would have been 21.5% without it.
Which is still lower than the 22% they did last year.
Correct. And that's the problem with these adjusted excuses. You can strip out the one bad deal to make the chart look better, but the cash in the bank reflects the bad deal.
Yeah.
The market looked at 20.1% and asked, is this the new normal? Because if costs are rising, you can't pass them on to the builder. That margin compression isn't a one-time blip. It's a trend.
Speaking of builders, we can't talk about Forestar without talking about the mothership, D.R. Horton.
The 800-pound gorilla in the room.
Yeah, for those who don't know the corporate family tree, D.R. Horton owns, about 63% of Forestar?
That's right.
So Forestar is technically a separate public company, but let's be real, they're the land bank for D.R. Horton.
It's a symbiotic, almost captive relationship. In the last 12 months, Forestar supplied 16% of D.R. Horton's starts and 23% of their lot purchases.
And the CEO, Andy Oxley, he came out and said their North Star goal is
to supply 33%, 1 out of every 3 homes that D.R. Horton sells.
That is a massive ambition. But does it create a ceiling? I mean, they did list sales to third-party builders this quarter to show they're diversifying.
It's a bit of smoke and mirrors, really. Yes, 16% of deliveries went to others, but when you dig into the transcript, a chunk of that went to a so-called land banker.
Okay, this is a term that gets thrown around on calls, but I feel like nobody actually explains the mechanics. What is a land banker?
Think of a land banker as off-balance sheet storage.
Okay.
Let's say D.R. Horton wants a piece of land, but they don't want to buy it yet because they don't want that debt sitting on their balance sheet looking ugly for their own investors.
Right.
So A land banker, basically a financial firm, buys the land from Forestar. They hold it. D.R. Horton pays them an option fee to reserve it. Then eventually Horton buys it from the banker.
So Forestar records a sale to a third party, but the land is actually just sitting in a waiting room until D.R. Horton is ready for it.
Exactly. It makes D.R. Horton's books look cleaner, and it lets Forestar book a sale today. But structurally, it's still dependent on the Horton ecosystem. It kind of obfuscates the real end-user demand.
Which brings us to the actual demand, the macro picture. Management used two phrases over and over again: affordability constraints and cautious consumer.
Those are the polite corporate euphemisms for interest rates are still too high and regular people can't buy houses.
But builders have been working around that, right? We keep hearing about mortgage rate buy-downs.
They are, but that money has to come from somewhere. If D.R. Horton has to spend, say, $15,000 per home to buy down the mortgage rates of the customer, that's $15,000 less in profit.
Which means they can't pay as much for the land.
Bingo. The margin squeeze rolls downhill. If the builder is squeezing their own margins to move homes, they turn around to Forestar and say, we can't pay you top dollar for this dirt anymore.
And it's changing how they buy the land, too. This was a fascinating nugget from the Q&A. Management admitted that builders are moving away from bulk takedowns.
This is huge. In the moon times of 2021, a builder would walk up to Forestar and say, I'll take the whole subdivision. Here's a check for 50 lots.
Fast cash.
Fast cash conversion, yeah. No. They're shifting to structured quarterly takedowns.
Just-in-time inventory for land.
Right. I'll take 5 lots in January, maybe 5 more in April.
That sounds terrible for Forestar's cash flow.
It's a massive drag. It means Forestar has to hold the land on their books for months longer. They pay the property taxes, the interest on the debt to develop it. They carry all the risk.
The risk is shifting from the home builder back to the land developer.
That's why you saw the volume drop 17%. The builders are tapping the brakes and forcing Forestar to hold the bag.
Let's talk about the capacity to hold that bag. Because despite the bad volume number, Forestar's balance sheet actually looks pretty bulletproof. They have, what, $820 million in liquidity?
Their financial health isn't really the concern here. In fact, their CFO, Jim Allen, made a really strong argument that their capital structure is their moat.
A moat? How so?
Well, most land developers aren't public companies. They're private, local guys who operate on project financing.
So they go to a local bank for a loan on one specific subdivision.
Exactly. And those loans are floating rate, so they're expensive right now, and they're restrictive. If the project stalls, the bank can call the loan and the developer goes bust.
And Forestar doesn't play that game.
No. They use corporate level debt, they issue bonds, they have shareholder equity, they don't have a bank breathing down their neck on every single acre. It gives them the flexibility to sit on land and wait out a bad market.
So they can survive. But investors don't buy stocks for survival, they buy for growth. And this leads to the biggest controversy of the whole call, the guidance.
The math here is, well, let's just call it optimistic.
They missed Q1 volume badly. They sold roughly 1,900 lots.
Yeah.
But they reaffirmed their full-year guidance. They're telling the market, don't worry, we're still going to sell between 14,000 and 15,000 lots this year.
Let's just break that down. If the goal is, say, 14,500 lots and you've only done 1,900.
You have 12,600 lots left to do.
In 3 quarters. You need to average over 4,000 lots a quarter for the rest of the year. That is more than double the pace they just reported.
That's what they call a hockey stick graph. Flat now, shooting straight up later.
It is backloaded guidance. And in the construction industry, backloaded guidance is terrifying.
Why, specifically in construction, why is it different from a software company saying they'll sell more in Q4?
Because you can't code a road into existence. You have physical constraints. You have weather. If it rains for 3 weeks in Texas in May, you are not paving those roads and you are not closing those lots.
Right.
If the municipality is slow on inspections, you miss your target. When you push all your volume to the back half of the year, you are betting that absolutely nothing goes wrong.
And you're also betting that the spring selling season is hot.
Correct. If rates tick up to 7.5% in March, the builders aren't going to ramp up their buying. They'll pull back even further.
So the market looked at that guidance, 15,000 lots, and effectively said, we don't believe you.
That is exactly what that gap down was. Yeah. It was a vote of no confidence in the acceleration. It's a show me stock now. Investors are saying, we aren't paying for 15,000 lots until we see the run rate actually hit 4,000.
It puts them in a weird spot. They're sitting on a mountain of inventory, 101,000 lots total.
That's a 3 to 4 year supply at the current pacing.
Is that an asset or a liability?
It totally depends on the price of dirt. In a bull market, having that many lots is a gold mine. In a flat or down market, it's an anchor. You're just paying interest on land you can't sell.
So we have a company with a strong balance sheet, massive inventory, but a sales pace that has hit a wall. And that specific contradiction, lots of assets, not enough velocity, is actually what sparked this week's not financial advice theory.
The math doesn't work unless you add a variable that isn't on the spreadsheet. Corporate politics.
Okay, let's get into it. This is the part of the show where we pitch a trade idea that is high risk, unverified, and possibly brilliant. We call it not financial advice for a reason. What's the play?
I'm calling this trade the forced liquidation squeeze.
Sounds painful.
It might be for the shorts. So here's the thesis. We know Forestar is struggling to move volume organically because builders are cautious.
Right.
But we also know D.R. Horton controls Forestar. And D.R. Horton has a vested interest in Forestar hitting its numbers, primarily to keep the stock price, and by extension, the value of their own holding stable.
So you think the 15,000 lot guidance isn't a prediction, it's a mandate?
I think it's an instruction. If we get to Q3 and Q4 and Forestar is lagging, D.R. Horton has the balance sheet to step in and force the volume. They can accelerate their own takedowns, effectively moving inventory from one of their pockets to another.
Ah.
They clear Forestar's backlog, Forestar hits the guidance, the stock rips higher, and D.R. Horton just warehouses the land themselves for a bit.
So D.R. Horton eats the holding costs to save the subsidiary's stock price.
Or to ensure Forestar has the cash to pay down its own debt. Remember, they're a team.
So how do you trade this?
Well, the market right now expects Forestar to be dead money because of the Q1 miss. Implied volatility is likely going to drop as people get bored.
So we want to bet on boredom now and fireworks later.
Precisely. The structure is a calendar call spread.
Okay, explain that in plain English.
You are selling a call option for the near term, say, expiring in April. You're betting the stock goes nowhere for the next 3 months. You pocket that cash. Then you use that cash to buy a call option for late 2026 or even early 2027.
So you're financing a long-term bet with short-term skepticism.
Yes. You are letting the bears pay for your bull ticket. If the stock stays flat through the spring, which the data suggests it might, you keep the premium.
And then?
Then, if D.R. Horton manufactures the volume beat at the end of the year to hit that $15,000 target, your long-dated call option could explode in value.
That is incredibly cynical. You're betting on financial engineering rather than actual home buyer demand.
Welcome to the housing sector in a high-rate environment. When the organic buyer disappears, the corporate treasurer steps in. Forestar's guidance is $1.6 billion in revenue. They are miles behind. If they catch up, it won't be because 2,000 random families suddenly decided to buy homes in November. It'll be because D.R. Horton decided to clear the decks.
The spring-loaded coil powered by corporate governance. I like it. It's dangerous. It assumes the parent company cares enough to intervene, but at $25.50 a share, the downside seems manageable.
The downside is the whole housing market collapses and D.R. Horton cuts Forestar loose. But with that balance sheet and that relationship, it feels like a calculated risk.
Well, there you have it, Forestar Group. A revenue beat that felt like a miss, a volume crash that needs a miracle recovery, and a market that is sitting with its arms crossed saying, prove it. It is going to be a very interesting year for the dirt business.
It certainly is. Keep an eye on those monthly housing starts. That's your leading indicator.
That wraps up this deep dive on talk tickers. If you want to know what the market is actually thinking, not just what the headlines are saying, make sure you're subscribed. We'll catch you on the next print.
Thanks for listening.